Well, greetings and salutations, test takers. This is Series 7 Guru coming to you from my off-grid studio, getting our kicks on historic Route 66. This is a Kaplan explication request. We'll help you with any explication request from any vendor, but if you have an explication request for Kaplan, just send me the QID and I can bring it up backstage. If you don't have a Kaplan Q Bank, I highly recommend it as a paid supplement. With my Guru 15 discount code at checkout, you can get a 6566 Q Bank for about, I think it's like $60 somewhere in there. So strong consideration should be given to doing so. For that commercial, Kaplan allows me to give you free look at Kaplan content like this. So, okay, let's look at today's request. Discounted cash flow is commonly thought as applying solely to fixed income securities. Remember, what we're trying to do in discounted cash flow is we're using the time value of money as a valuation technique. We know that if I have a bond paying me, I'll make up a number, 6% for 10 years, that's $60 in annual interest paid semi-annually. So that means I'm going to get 20 payments of $30. I know the $30 6 months from today is worth more than the $30 10 years from today. And so what I want to do is see what is the present value to decide whether it's overvalued, undervalued, or fair valued. If the market price is close to the present value, well, then it's pretty efficient, fairly priced, right? I'd be looking for positive net present value. All right, so let's talk about DCF as applied as a valuation technique for common stocks. Well, discounted cash flow is about a future income streams and discounting them back to present value. So price to earnings is certainly a valuation technique, but not about cash flow. PE, price to earnings, is a valuation technique. And the test question here is to recognize that value investors would be looking for a lower price to earnings ratio, and growth investors would be willing to pay a higher PE ratio as a valuation technique or multiple because the idea of the earnings are going to grow. I heard somebody on CNBC the other day and they said, the PE of the market is kind of high, but if the E grows, then the P stays. Could still work out. The dividend discount model, absolutely. So as we said, what we're trying to figure out is what is the present value of the dividends. So, for example, if we're looking at Bank of America pays a 21-cent quarterly dividend. And again, I know that the 21-cent quarterly dividend this quarter is worth more than the 21 cents I'm going to get, 10 years from today. And so what I'm trying to do is figure out what is the present value of those dividends. And again, I'm looking at present value in comparison to the market price to decide fair value, overvalued, undervalued. For example, if I do discounted cash flow on that 21-cent dividend and I find out the present value is 40 and I can buy Bank of America for 35, it has positive net present value. If, on the other hand, I do the present value calculation, a discounted cash flow using the dividend discount model, that's what it's called as applied to a stock, and I find out the present value is 40 and the price of, Bank of America is 45, I'd say it's got negative net present value. Here it says, so that's part of our answer set, certainly. And again, the assumption is the dividend is going to be a constant, it's not going to change. So we can apply that as a valuation technique to both a common or a preferred stock. The discounted book value, there's no such thing as the discounted book value. There is price to book as a valuation technique, but it's not something that is here in this question, right? The assumption on the dividend growth model, right on. So there's our answer, 2 and 4. Now we can't apply this to a preferred stock because remember, now we're assuming that that dividend of Bank of America is going to grow. That it's 21 cents today, but over the course of the few years, let's say they bump it next year to 24 cents and 2 years later to 27 cents and 3 years later to 30 cents. The idea here is that when I'm doing the discounted cash flow, the present value, I'm assuming that those dividends will grow, and then the result will be a higher valuation. I'd be willing to pay a higher price based on calculating present value using the dividend growth model. So the answer to this question is A, 2 and 4. As a bonus, though, let's talk about that price to book, right? That price to book as a bonus. So if we're looking at banks, price to book isn't a big deal in a lot of industries, like, who cares about the book value of NVIDIA? But in financial institutions like bank, it's a very important metric used in valuation. And so if we took the price of JP Morgan and we divided by book value, tangible assets, it'd be 1.2. So we're basically paying $1.20 for a dollar's worth of tangible assets. We did it for Bank of America, it would be one. We're paying a dollar in market value for a dollar in book value or tangible assets, however you want to think about that. And then we look at Citigroup and it's 80%. So now I'm paying 80 cents for a dollar of tangible assets. And using that valuation technique, we would say, well, maybe Citigroup is undervalued, right? So there's no such thing as discounted book value, but there is such a thing as price to book that you might encounter on your 65, 66. So you'll encounter 1 and 3, but the answer to this question that you may encounter is 2 and 4. Remember, inch by inch, dividend discount models and dividend growth models and discounted cash flow and present value are cinch. Yard by yard, they're hard, and I'll see you for the next explication request.